What overlooked tax benefits does mortgage refinancing offer? Imagine turning a simple financial move into a way to keep more money in your pocket each year. That's what understanding the hidden tax benefits of refinancing can do for you. When you refinance your home, you might not realize there are ways to save on taxes that can boost your overall wealth. These benefits are especially helpful for building long-term wealth through real estate. One of the biggest benefits is the mortgage interest deduction. This allows you to subtract the interest you pay on your new loan from your taxable income. So, if you earn $50,000 a year and pay $5,000 in interest, you only pay taxes on $45,000. This deduction applies to loans on your primary home or a second property, as long as you itemize your deductions. Keep in mind, for loans taken out after December 15, 2017, the interest deduction is limited to loans up to $750,000 for single filers or married couples filing jointly. If your mortgage was before that date, you might be able to deduct interest on up to $1 million in mortgage debt. Points and origination fees paid during refinancing are also tax deductible. But unlike points paid when buying a home, these are deducted over the life of the new loan. For example, if you refinance to a 15-year mortgage, you spread the deduction over 15 years. This means you deduct a portion each year, making it easier to manage your tax savings. Property taxes are another area where you can see benefits. When you refinance, you can still deduct property taxes paid on your home, but there is a cap of $10,000 on combined state and local tax deductions. If you rolled unpaid property taxes into your new mortgage, those payments could be deductible too. Just be sure to talk to a tax professional to make sure you're maximizing your deductions. If you decide on a cash-out refinance, there are specific tax rules to keep in mind. The money you borrow through a cash-out refinance isn't taxable income because it's a loan. However, the interest on that cash depends on how you use it. If you use the funds for home improvements that increase your property's value, you might be able to deduct some of the interest. But if you use the cash for debt consolidation or repairs that don't add value, the interest isn't deductible. The interest on your original mortgage remains deductible regardless of how much equity you access. For Black homeowners working to build wealth across generations, these tax benefits can add up over time. By understanding and taking advantage of mortgage interest deductions, points, and property tax deductions, you keep more money working for you. This extra capital can go toward buying additional properties or paying down your current mortgage faster. It's also good to remember that, when you refinance to a lower interest rate, your total tax deductions might decrease because you'll pay less interest overall. But this trade-off usually works in your favor because the monthly savings from lower payments often outweigh the smaller tax deductions. Keep detailed records of your refinancing costs and how you use the funds. Most closing costs and settlement fees aren't deductible, and homeowners insurance isn't either. Working with a tax professional can help you claim all the deductions you're eligible for and avoid mistakes that could cause issues during an audit. Understanding these overlooked tax benefits can make a real difference in your financial journey. By planning your refinancing carefully, you can keep more of your money and build wealth through your home and real estate investments.